Hey there, and welcome to your monthly market update from your realtor, Renee. So in August, what is going on in the real estate market? What we can see right now is we're headed in the right direction. The last couple months, you've heard me talk about how we really needed more available homes for the buyers that are out there so that when a buyer finds a home, they're not competing against 10, 15 other offers. And that's exactly where we're headed right now. So this first slide that you're gonna see is showing the inventory levels of homes. And the red in the middle is showing what happened when there was way too much inventory. That's what caused the market crash in the early 2000s, 2008, 2011. There was just simply way too many homes and not enough qualified buyers. And if you look all the way to the right side of the screen, you're gonna see where we're at now. We had record low inventory levels, meaning buyers were just having to go way above and beyond to be able to secure a home for themselves. And this was making people bid $10,000, $15,000 over or completely get priced out of the market, and they weren't even able to buy a home. But with us going in the right direction, you can see today it's at 3 months nationally is the average of the inventory, and we're going in the right direction. So that oversupply of homes that we saw in 2008 to 2011 is what caused home values to go down. But with having such a low inventory and a low availability of homes to buy for the buyers that are out there to buying them, it supports that supply and demand where if you have enough supply to meet the demand and you are even teetering a little bit into not enough supply to meet the demand, that's when we know that home prices are going to continue to appreciate over time. Not quite as quickly as we have seen over the last year or two, but they will continue to appreciate, and we'll talk about that in just a little bit. So another really great indicator of why the market is being so stable right now is because you can see in this chart weekly mortgage rates continue to fluctuate, meaning that we did see them go up really quickly earlier this year. It went from the low 2s into the mid 5s, and for a lot of people that was big sticker shock, and it caused them to really pull back and reevaluate if they wanted to buy a home because their price range changed, their payments went way out of whack of what they were expecting, and it caused them to reevaluate. And as you can see in this chart, we've been monitoring the mortgage rates and they've actually gone down over the last couple weeks, which is a really good sign because even though 4.9% is still much higher than it was earlier this year and a hard pill to swallow for those that may have shopped when it was in the low 2s, overall, this is still a great average and a great interest rate to have. And you do have the opportunity to refinance if rates ever went back down. But we do still think that home values will continue to appreciate. So even if you bought a home with a 4 or 5% interest rate now, you're buying that home at whatever it's priced at now. But if you waited until next year and the home values continue to appreciate, we don't know where interest rates will be, but we do have really good insight to think that home values will continue to go up. One of the other indicators that we can look at in the national market to see what builders are expecting, what home builders are expecting in the coming months is we look at, on this chart you'll see building permits and housing starts, which are good indicators of, they're good leading indicators to know what is coming and what's ahead. And then the under construction and the housing units completed are good lagging indicators to see what is currently on the market, what has been completed recently, and then the leading indicators above of the building permits and the starts shows us what they're projecting and what they're planning for. And so what we can see is that they're bringing it in a little bit. The building permits and the housing starts, they're taking it down a notch. Their demand just isn't quite as heavy as it was earlier this year. And so they're pulling back, just indicating that they don't want to oversupply and overbuild. If they were to oversupply and overbuild, then their supply would be sitting on the market for a little bit longer than intended, which causes them to lose money. So we can see that they're pulling back a little bit, showing that their best guess is that the buyer demand is softening a little bit. And so builders are actually pulling back on the amount of homes that they want to put out there. After 2008, the lending industry tightened their standards so that we wouldn't face another mass foreclosure incident like what we saw in 2008. And so when we had that mass foreclosures, we had so many foreclosures that the supply went way up and the demand went way down. And that's what caused home values to decrease back then. So what we're seeing now is that now we're exiting out of that time frame of the foreclosure moratorium where the government was not allowing lenders to foreclose on properties. That was so vital during a pandemic to allow people to figure things out without having to face foreclosure on their home during a pandemic. So now that we're kind of coming out of that, we're seeing that yes, foreclosures are on the rise, but that's because they were literally not allowed over the last couple of years. So if you're hearing that out in the media and out in wherever you get your information from, yes, foreclosures are on the rise. And yes, that's normal. There's always going to be some level of foreclosures, except when the government prevents it. But as you can see on this chart, it's going over those foreclosures over time, and you can see after they tightened the lending standards in 2011-ish, foreclosures just really went down after that. And even before the pandemic, foreclosures were way low, and we don't have any indication that we're going to see a mass foreclosure or a mass supply increase that would tank the market. With all that said, we're really not seeing any indicators of a crash headed our way. This chart is actually going to show you the difference between a buyer's market and a seller's market. And if we were to enter into a really strong buyer's market, that's when you see depreciating home values. But right now, we're actually still in a really, really hot seller's market, meaning that there's so many buyers out there that sellers are not having to reduce their price to a point that reduces the value of homes overall. Sellers are still able to put their home on the market, and even though it might take a little bit longer than what we were seeing earlier this year and over the last 2 years, we're still able to put homes out there, price them well, and get them under contract within a reasonable amount of time, which means that we're still in a seller's market. Now here's where we can see how this is affecting us here locally in the San Antonio area. On this chart, you can see that Guadalupe County, Bexar County, and Comal County, the top 3 counties in this area that contain San Antonio, Shirt, Cibolo, and all the way up to New Braunfels, their inventory has gone up. But look, we're still under 3 months in Guadalupe County, under 3 months in Bexar County, and Comal County is just over 3 months. So we're still in a seller's market. And so as we look to the future of what we think is going to happen over the next couple months, the experts are all indicating that they really think that even taking into consideration that we may be headed into a recession, they do think that interest rates for mortgages will continue to hover right inside of that 5% and even continue to potentially dip under 5% here and there. And that's a really good sign because we did have a really, really hot market. When the interest rates were so low, it just made people want to buy homes because it was so cheap to do so. And by raising the interest rates a little bit, it was able to knock out those people out of the market that were really just wanting to take advantage of the low interest rate, which is totally great, and nobody can blame them for doing that. But a lot of people now are deciding that if they don't need to buy, they're not going to. They're not just making a move because it's a good time. It's really those people that maybe they're PCSing or they're moving for a job. They're people that have to move and really want to. It's their life plan to move at this point. Those people are still able to go out there and still be able to buy homes. And with interest rates hovering around a reasonable range, experts also think that home appreciation is still there. Now, over the last couple of years, it might have felt like our market was, it kind of got used to operating at 150 miles an hour. And with the interest rates going up and the recession hitting, it kind of caused everyone to put the brakes on a little bit. So now we're operating more at like 120 to 100 miles an hour. And so when you think about, yeah, man, there is a slowdown, but we're still going 100 miles an hour. That's still pretty fast. The market is still good. It's not what it was a couple months ago, but that's really good for buyers, and it's not bad for sellers. It's just a little bit different. With interest rates maintaining a normal standard pace and not going to the 8, 9, 10% that a lot of people were worried that it was going to go to, and home values continuing to appreciate, it's not a bad time to buy a home. It's not a bad time to sell a home either. We are going back to a more stable market like what we saw 2018, 2019. And if you're interested in buying or selling a home, just know that's a great place to be, and we won't be operating out of any kind of frenzy or any point of disadvantage. So that's what's going on in the national and San Antonio area market. If you have any questions, I'm always here to help. Feel free to reach out to me wherever you're watching this video, or my email is linked below in the YouTube, and I will talk to you soon.